Well, good evening, everyone, and welcome to the Brian Crombie Radio Hour on Saga 960. I've got an interesting concept to present to you tonight with Ken Stern. Ken Stern has been in the investment insurance advisory business for several decades, and he's got a concept that we're going to chat about tonight, flow-through shares, that really is a tax structure and strategy for accredited investors that I think makes a lot of sense. It's something that I've encountered previously in the mining business, and I think it's got applicability in a lot of other sectors of society. Ken Stern, welcome to the show, sir.
Thanks, Brian. Thanks for having me, and certainly glad to chat with you about this strategy, which actually has been around for quite some time.
Well, tell us a little bit about what the structure is. What is a flow-through share?
So flow-through shares are shares issued by mining companies. Used to include oil and gas, but in the 2022 federal budget, they got rid of that, I guess, for the green agenda. But these are shares issued by mining companies for the sole purpose of exploration. And you can imagine that if an entity is doing exploration, they don't really have revenue, but they obviously have expenses. So the government, because they want to encourage this economic activity and mining, which is great for our economy, and most of the mines tend to be in remote areas, often employing indigenous people. The government wants to support those efforts, and they allow, with certain caveats, the mining company to issue shares against expenses that they will incur. So the purchaser of those shares gets to write off those expenses as if they had incurred them themselves. So flow-through shares have a tax component whereby you can deduct 100% of your purchase against your current income. Now, that can't be done to eliminate your income completely. There's a concept called AMT, or alternative minimum tax, that is a separate calculation. It's a little complicated, so I'm not going to get into that, but you can't just wipe out your entire income. In addition, you can purchase these shares through a limited partnership or a mutual fund, and they have certain limitations that our transaction doesn't have. One of those limitations is that you have to hold the funds or the shares for at least 4 months and a day before you can sell them. And that opens up the price volatility and the illiquidity risks that are in this transaction. Our transaction eliminates those two risks because we do this on what's called a bought deal basis. Bought deal meaning that the shares are bought and sold at prearranged pricing on the same day. So our clients do not have to wait 4 months and a day. We eliminate the illiquidity because we're selling them the next day. We eliminate the price risk because we prearrange a back-end liquidity provider. So I know that that's a lot of information.
How do you do this? If the rule is that you got to hold it for 4 months and a day, how do you get around that to do this bought deal?
Well, it's very simple. So there's something called National Instrument 45106, and then subsequent 45102, which basically says this can be traded on a private sale basis, not a public market, between two accredited investors. So let me add something about accredited investors. So when I said that you can purchase these types of shares through a limited partnership or a mutual fund, anyone and everyone can do that. Our transaction is strictly for accredited investors, and the way you are qualified as accredited is a couple of ways. First is that you earn at least $200,000 a year, have done so for the past 2 years, and expect that to continue in the future. You can also do it if there's $300,000 of household income on the same basis. And you can become accredited as well if you have $1 million or more of investable assets, not including your real estate. So our transaction is strictly for accredited investors, and it's been going on since 2006. There have been no hiccups, and it's tried and true. So by using 45-106 and 102, we get around that restriction. But I'd like to tell you
Sorry, go ahead, sir.
Yeah, I was going to tell you a little anecdote about my experience with flow-through shares as an investment advisor.
Please.
I only bought flow-through shares in a limited partnership once. Unfortunately, I took a large amount, $50,000 of my wife's money. And by the time we were able to sell it, that's the 4 months and a day, but limited partnerships usually take up to a year or more to be able to sell. So by the time I was able to sell, that $50,000 investment became $5,000. So yes, we got tax benefits. My wife was mad at me for a very long time. And at that time, I vowed never to go near them again, never. And I didn't during my career. However, when I sold my business in 2017, I needed tax relief. And somebody introduced me to this bought deal transaction, which I participated in. That's now 6 years ago. And of course, no repercussions with CRA or anything like that. And I thought I was going to retire, but I was bored. I got bored very quickly. And for anybody out there thinking about retirement, I urge you to consider what you're going to do in retirement. So I came across this strategy. I participated, as I said. And then within about a year, I thought, maybe I'll go and offer this to people and be essentially a representative for one of the companies, which is what I did. There are only 4 companies in Canada who do this. I represent 2 of them. And it's just been a very successful tax strategy for many years. But again, not for everyone, only for accredited investors.
If people are intrigued and or an accredited investor and want to access some of these opportunities and your services, how do they best do that, sir?
So it's easy. My excuse me, my website is ken@kenstern.ca. That's stern like the back of a boat. It's got a lot of information on there. You can find me on LinkedIn. I'm fairly active as well. And if you want me to give my phone number, I'm happy to do that as well.
No, kenstern.ca. kenstern.ca. We're going to take a break for some messages and be back in just 2 minutes with Ken Stern. And we're going to talk a little bit about sort of the principles of flow-through shares and whether they make sense and whether they make sense for you as an investor. Stay with us, everyone. We'll be back in just 2 minutes. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. We're chatting tonight with Ken Stern. He is a financial expert specializing during his career in financial and insurance strategies for people in his wealth business. But in retirement, he's really focused on flow-through shares and bought deals for flow-through shares for accredited investors. That sounds like really quite an interesting tax structure and strategy. Ken, though, I want to step you back, if I could. Flow-through shares, I think, make a ton of sense. And what they are is they really are an opportunity for a mining company that is doing exploration and development. And as you said, it's a incentive effectively that the CRA and the Canadian government puts in place to assist and incentivize exploration and development by allowing investors to take as a deduction against their income the exploration charges. And when you think about those charges, if the company was profitable, would be completely tax deductible. And so therefore the investors would enjoy only the after-tax income of that company. And yet before they're profitable, they cannot deduct it from tax. And so therefore you're effectively paying 100% of those expenses. And flow-through shares allow the individual who does have income to deduct it. So I think it makes a ton of sense. But my question for you is, if it makes a ton of sense in the mining business, why doesn't it make sense in other industries? You said it was available in oil and gas, and oil and gas is just as important, if not more important, to the Canadian economy as mining is. So why can't we have flow-through shares in oil and gas? And I used to be in the biotech pharmaceutical business, and biotech spends, hundreds of millions, if not billions of dollars before such time as a drug candidate comes to market and starts making money, or high tech when you've got a bunch of investment up front. If the same principle exists, that it makes sense to incentivize exploration and mining, why doesn't it make sense to incentivize development and exploration in biotech, in farm, in medical equipment, in high tech, in oil and gas?
Listen, I don't disagree with you. Excuse me. I don't disagree with you, but those kinds of questions are pretty much above my pay grade. The reason the oil and gas have been deselected, if you will, from this industry or from the flow-through share regime is because the government feels that it's not green enough and they want to stop it. I don't buy that. I think that oil and gas are also important to the Canadian economy, and they should be supported. And even if they're going to be phased out at some point, we're not ready yet. And there's a lot of time in between now and when we'll be ready. And I do agree with you, Brian, that oil and gas is very important to the Canadian economy. So is biotech, so is technology research, et cetera. There are certain tax advantages that are available in those spaces. Unfortunately, I'm not familiar enough with them. This is a very well-defined area that I'm in. And, it suits me well. When you're an investment and insurance advisor, the number of things that you have to keep on top of on a day-to-day basis are pretty overwhelming. And at a certain age, it's just a little too overwhelming. So this suits me well because it's a very narrow lane. I know it pretty much inside and out. I'm not a tax expert per se, but I work with companies that have tax expertise and are happy and willing to advise my clients, people I bring to the table, on the most efficient way to optimize the benefits of flow-through shares. So you make a good point. Government could support many businesses that are critical to the Canadian economy. But certainly, everyone pretty much understands the role of mining in Canada. We're, number one, number two in mining in the world. Australia is another country that also does this. I don't know if they have flow-through shares in Australia, but they're a very heavily mining-oriented economy as well.
So I think that, this is a principle that we really need to address from a tax policy, government policy standpoint. I really do. When you think about REITs, real estate investment trusts, they're effectively flow-through shares. You can flow through pre-tax income or pre-tax losses to the investor, and I think that that's a huge benefit. You've got limited partnerships that can do the same thing, where you flow through pre-tax income or pre-tax losses to the shareholder or the investor. And I ended up having an argument, Ken, with someone the other day about whether this is a loss to the Canadian Treasury, to the government, and so therefore the taxpayer pays. And please correct me if I'm wrong, but I argued that it's not, because effectively what would happen is the mining company, the pharmaceutical company, whatever the company is that was arguing for those flow through shares and those tax losses to be able to be taken as a deduction against the income. If they didn't have that opportunity, what they would do is just wait until they're profitable and take the deductions then at that time. And so therefore the deductions would be deducted against income at some point in time in the future, but delayed. And so the benefit of this is that you get that deduction earlier when what's happening is what you want to have happen, which is exploration, development, new ideas, development that can change companies' trajectory in the future. versus waiting around a couple of years until they become profitable and it's already proven, and then you get the deduction. So my question to you is, do the Canadian taxpayers in general lose from having flow through shares, or do all they do is accelerate when the deduction can take place?
I don't think the Canadian public loses in any way, because these companies are exploring and ultimately will be productive mines, what will be productive mines, adding to the Canadian economy. It's not just about the expenses that they incur. And to be honest, a company can waste a lot of money along the way exploring, I don't know what the term is, dry holes or whatever they could be. This gives them a reason to be able to do that exploration, which ultimately does benefit the Canadian economy. So I don't think the taxpayer ultimately loses out. I think there's an additive effect when they do finally discover whatever minerals they're looking for. And by the way, just one thing I didn't mention as well, besides being able to deduct the cost of these shares or whatever your investment is, there's an additional investment tax credit that the federal government offers, which is an extra 15%. And in the case of critical minerals, which we've heard a lot about over the last year or two, very important minerals needed for the green energy agenda, the government in 2022 added an extra 15%. So there's a 30% investment tax credit available when a geologist certifies that they are going to be exploring for these critical minerals.
I think this is a really important conversation, because I think what you're providing is beneficial to the economy, but I also think it should be expanded, as I've argued, and I think it should be available in more industries. And you commented that there's other ways that the government provides similar incentives in other industry sectors, and that's true in technology and in biotech, pharmaceutical, medical equipment, et cetera. You can apply for what's called SHREDs, which are scientific research deductions, but they're not nearly as effective. What you do in that situation is you've got to get an audit done of your expenses. You've got to get a consultant to comment on those expenses. You got to submit it to the federal government, to Revenue Canada. It takes a long time for the money to come back. There's companies that are established to help you do all this. They take a fairly sizable commission on them, and the loss to the developer is significant. Number one, in time to get the deduction, and number two, in the administrivia in getting that deduction. The nice thing about flow-through shares is the government just stays out of the way. It's private enterprise that decides where it is that they want to develop and explore, and it's the investors that yes, they get the deduction, but the reality is, I guess typically not in your situation, because you're able to do the bought deal and sell it to someone else, but they take the risk as to whether the money is going to be well spent. And in your case, even though the initial investor that gets the tax benefit doesn't have to take that long-term risk, the next investor that's buying them in the bought deal does have to take that risk. And so therefore, there is this incentive that companies have to make sure that the money they're spending is spending in smart development, smart exploration. It can't be just wasted. It's got to be invested in expenses that make sense, because you save the tax shield, the tax benefit, but you don't save the whole amount. And the balance of the investment in those flow-through shares hopefully turn out either for you, the investor, or for the other investor in the accredited investor scenario that you described, buys the shares from you.
Yeah, I want to just explain a little bit structural about the transaction. So first and foremost, these are considered private placements. So it's not like a mutual fund or an ETF where you can buy it at any time. These deals are lumpy. So you have to wait until a mining company is ready and willing to issue these new shares. And of course, there's companies that are bidding for those shares. So it is a competitive process. The issuing company commands a premium on the share price because of the embedded tax benefit. And then somebody will ask, well, what's the incentive? Why does somebody want to be the back end? Why do they want to buy these shares from you? The fact is they can buy them on the open market. So we also have to discount those shares to the end buyer. We call them the liquidity providers. So there's always a delta between the purchase price and the selling price. It gets a little complicated with the tax treatments and ramifications, but those are very important concepts to understand. So deals are not always available. They're available lumpy from time to time. The expenses, there's a certain prescribed time frame and certain prescribed expenses that are eligible under this rubric. So you can't spend money on sales. You can't spend money on general administration. That has to be for exploration. And that is the one risk that remains after the transaction. The risk that the issuing company doesn't spend the proceeds on eligible expenses and within a prescribed time frame. However, we do also mitigate that risk with an indemnity that's part of the subscription agreement that says within 20 days of notification, 20 business days of notification by CRA that they are auditing, our investors will be made whole, not waiting for adjudication, which can take years. So in the subscription agreement, and the issuing company has to follow through, because if they don't, and they abrogate that one caveat, they'll never be able to raise money again. So it's in everybody's interest that all of this risk gets covered off, and that the company does spend the proceeds properly within the time frame, or they will have to make good to the investor.
But that's fair, because if you're buying a flow-through share, which means that you're effectively expecting, whatever your tax rate is, let's say it's 40% or 50% as a deduction, you're effectively bargaining that you're going to be able to buy that share for net half the price. Let's say a share costs $100 and it's a flow-through share, so you're going to take a 50% flow-through deduction on it. You're bargaining that you're buying it at 50 cents on the dollar. And if they don't spend the money, then you should get indemnified.
Yeah, and it's not quite 50 cents on the dollar, but
what would the average be? What would the average be?
Well, when you sell, let's say you buy for $100, you're going to sell these shares for about $65. And you have that $65 in your pocket, but you've written off $100. So you've saved $50 on the write-off, and you've got $65 in your pocket. You actually got $115 when you started with $100. It gets a little complicated without seeing the numbers on paper and going through them. It's easy once you see them, but talking about them without numbers in front makes it a little more difficult to follow.
Well, I'm going to have to check it out. So remind us, sir, of the website we go to.
kenstern.ca, www.kenstern.ca.
But you have to be an accredited investor. So this is not available to everyone.
Correct. And I would say the last thing I would tell you is that all of the deductions make sense when you're in the top tax bracket. So after all deductions, and in Ontario, the top range is about $240,000. So after all deductions, including RSP deductions, et cetera, you should still, to optimize this, be at the top tax bracket, which is 50.53% in Ontario.
So it only makes sense for people that are
high earners.
High earners.
High earners, yes. And corporations as well. And there's a charitable component, which we didn't get into. Maybe we'll talk about that on another occasion. But using these flow-through shares, we can reduce the net cost of giving significantly. Normally, it's about 50 cents on the dollar. The easy one is 25 cents on the dollar. And with the proper structure, we can bring that down literally as low as 1 penny per dollar of donation.
Fascinating. That does sound like another interesting topic. But I have to say, from a principle standpoint, I think it's again wrong that there are these extra tax structure opportunities available to reduce tax, but only available for high income earners and accredited investors. And I do think that that we make a mistake as a society when we make available good opportunities to people that are high income earners that we don't make available to everyone. And I guess the determination the government comes to is that if you're making over $200,000 a year and you're therefore an accredited investor, you're smarter or something like that you can make better decision making. I think that's wrong. Why?
Yeah, we know that's not true.
Why exactly? So why do we have this structure that says that good investments and good tax structures are only available to high income earners? Should be available to everybody. And I think that's a mistake. And it's sort of a paternalistic kind of an attitude that says only rich people, only accredited investors are smart enough to make decisions when they're saving taxes. And we end up having a situation in our society where low and middle income earners are paying more taxes because they don't have some of these deductions available. I think that's a wrong strategy. I understand it because they don't want everyone taking undue risks, but I wonder if it's the right thing from a societal standpoint to do. Anyway, Ken Stern, thank you so much for joining us today and helping us understand some of these tax structures that are available through flow-through shares. I've been an investor in flow-through shares, but never in the way that you've described. I've just bought them directly, and I think they make a lot of sense. And I have argued in front of different committees and government individuals that they make sense to be wider used in oil and gas, and particularly in biotech, pharmaceuticals, and in high tech, because I think that the principle that you're exploiting and helping to develop mines in Canada makes sense in other industry sectors as well.
Brian, thank you very much for having me on, and look forward to chatting again sometime.
We're going to take a break and come back with another interesting topic in just 2 minutes. Thank you, Ken Stern.
Pleasure.